What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of the video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. Kicking things off on our SPY weekly time frame, talking about candle structure and location as we always do. For structure this week, we certainly have a bearish inverted hammer candle. Simply put, the sellers really stepped up at the highs, pushed prices back down to the open and through the open for a relatively weak close. It could have been worse with a close dead on the lows, but obviously this lower wick would also imply that there was some buying activity that at least kept prices off of, again, just the dead lows of the weekly range. However, it certainly was not enough to change the candle to a green bar on the weekly session with a close above the open. So from a structural perspective, certainly the bears here do take the win. From a location standpoint, you can clearly see a bar-to-bar equal high. We'll talk about the importance of that level on the daily time frame in just a second if for some reason it comes back into play, but in the bear camp as well, a new significant weekly lower low, right? I think the more important takeaway from the weekly chart, though, is just the overall context of this move. Remember in last week's video, we talked about the fact that usually on 100% retracements, it's very rare that you just immediately see significant follow through, and we were looking for some sort of dead cat bounce. Well, yeah, this upper wick would certainly constitute dead cat bounce from a weekly perspective here, and now that we've basically closed for an equal low down around these areas, I would say it would be reasonable to expect some more significant follow through now, considering that, again, quote unquote, the chart structure has been repaired from that sort of round trip sort of psychology that we've been discussing over the past couple of videos. I would also point out that we are seeing an increase in volume as all of this is unfolding, which generally speaking leads itself to continuation, not necessarily some sort of muted move. Obviously, on the first initial look of the pullback from this move right here, just those 2 weekly bars, volume was muted, right? That seemed reasonable for a pullback, but now that volume has been increasing on the way down, generally speaking, that's obviously no longer just a mild pullback. So note, all of these things are falling into the bear territory. If we scrunch up the chart and bring into play pattern as well, we talked about this last week. Here's your head and shoulders pattern. Remember that your neckline is now a moving target. We basically bounced right off of it in the last week's worth of trade. The question for this upcoming week is, of course, does that break down? Do we get a strong weekly close underneath? In which case, that definitely triggers a more substantial breakdown of the pattern. And from there, we would watch to see what type of follow through we ultimately get. Before we move down to the daily time frame, I would also point out that our gap here is technically a weekly gap. We'll see those levels on the daily chart in just a second. So do we come down and fill that on the weekly? Could be a possible target, as well as this general area right here as a breakout point could be retested as newfound support around 395. Again, just tying all of these weekly levels in to what we'll see right now actually on our daily time frame. So let's just go there now, start talking about tradable levels into this upcoming week, what we can expect, so on and so forth. In last week's video, you guys really seemed to respond favorably to the expected move, so we've added that to our chart once again for this week's analysis. One thing I would point out about this is that our close here is very similar to what we had last week, but our expected move has actually contracted. Volatility has contracted. Last week, this was the top end of the expected move, and last week, this was the bottom of the expected move. You can certainly see how that's now muted by just a little bit. Nonetheless, all significant areas to the upside. The first couple of things I would say about our daily time frame chart is that on Friday, we certainly saw a bearish acceptance bar underneath all of this consolidation that was starting to constitute a bear flag look, right? So to me, that falls into the bear camp right off the bat. Obviously, we've also retraced 100% of that FOMC spike. Strikes me as being bearish as well. The spike base was somewhere around here. Again, Friday's action, pure acceptance underneath that euphoric rally base that we saw in there. Bear territory. To the upside, if anything even remotely bullish is going to unfold this week, we first have to recapture the highs of Friday essentially and break back into this area of balance from here. That's 415.50. So that's going to be the first big hurdle to the upside. After that, we've got 422.50. We've talked about the importance of that level in the past week's worth of trade. So let's actually see that on the 30-minute time frame. Notice all of the interaction here. here, as well as on Friday. That was really the most important day, and that's why we're really carrying it forward here. It was the low of the opening range, and then we perfectly backtest it for resistance before selling off. We are yet to recapture that level to the upside. Notice that on the FOMC spike, right through it, and then right back down through it. So I would still carry that forward as a significant level, and it's also roughly aligned with the upper edge of our expected move into this upcoming week's worth of trade. So those are our upside levels. Really, the last thing I would point out, and we sort of alluded to this on the weekly time frame with the equal highs, is if for some unknown reason, and again, I do not carry this as a likely scenario into the early part of the week at least, but if we do come into this area of highs around 428.75, treat that as a weak area because all of these highs are so exact and we now have 3 touches to that same area. So for, again, just completely speculating here, but let's say we do something like this. On that next test of that, boom, you're probably looking for that area to get taken out, and we have thin structure off to the left. You could look for that to be retraced fairly quickly. Again, not favoring that as a likely scenario into the early part of the week, but again, we'll keep you updated on Wednesday in the midweek market update if that level does look like it's starting to come into play. Another reason why I don't necessarily think that we're going to get there is if we take out the Fibonacci's from the high of the breakdown really all the way to our low of Monday, where it seemed that we've put in a temporary low, notice that our Fibonacci 38.2 is roughly aligned with that 422.50, roughly the top end of the weekly expected move. It would strike me that anything now that really just remains in this overall territory is continued bear flag consolidation, bearish acceptance at these lower prices. To the downside, if we do see just, consolidation and then a breakdown, it's really going to come from a violation of 405, and then you're looking for that weekly gap to fill from 403.38 down to $400.67. After that, our weekly expected move low is around 397.77. But we do know that the more structural and significant support could be coming in around 394. We pointed that out on the weekly, but let's just grab an extra year or two here to see that on the daily as well. Zooming in, you can see we had prior resistance, and then a breakout that has yet to be tested here on the daily time frame chart. So those are my levels both up and down, basically through everything we've discussed so far. I would say that the market is probably favoring some downside here based on all of the evidence that we've seen. Let's go ahead and take it a step further and break out our S&P sectors. What do we see in the energy sector? Let's actually drop this down to just a yearly chart as well so we don't have so much data. Obviously, energy is peaking back above this prior breakout point. It looked like a fake break here, but now that we're back above, again, this is not a good look for our S&P 500 finding a more meaningful bottom. This strikes me as more of a risk-off type of look here in energy. The same thing is going to hold true with utilities. Basically, actually, I suppose I take it back. It's not as bad as energy. We're clearly off of the highs, and we're just getting some sideways acceptance in here. So yes, I do take that back. This is really a more favorable look as opposed to what we've seen in energy. We do not want to see energy leading the pack to the upside. Really wants to be more muted. So XLU, fine. But as of right now, what we don't want to see, like a look we would want to avoid, is some sort of breakout. Oops, if I just grab our other tool, apologies for that. If we see a breakout up and over this sort of 72.25, 72.50-ish area, prior resistance, support, and resistance here, and we get something that does that, that starts to become a little bit more concerning in utilities. Ideally, this just plays nicely and chops around in this overall area. So keep it on watch. If utilities start to perk off, again, that would start to fall back into the risk-off category. Consumer staples, what do we see here? Again, more of a sort of neutral look for now. It is underneath the neckline of its head and shoulders pattern right here. So again, this strikes me as a decent look for, not so much an aggressive risk-off type look here. So the fact that this is just going sideways in here strikes me as a good thing. We want to see this continue to play nicely in this general area. If it does want to explore above that 78 quarter, basically what we want to avoid is some sort of squeeze that takes it to a new high. As long as we remain underneath these highs around 81, I would say that's okay here in the XLP. But for now, this sideways look here is decent. Let's see if we can keep that up and keep the moves muted here in staples. Healthcare, what do we see? Certainly sideways as well. Not a whole lot going on here. What I am sort of unfortunately going to bring to you is the fact that we've clearly resisted at the neckline from our prior double bottom 1 and 2 here, and we're rolling back over. So we really have more of a break and retest phenomenon that, of course, would lend itself to lower here, especially with Friday's activity, sort of getting more bearish price acceptance lower in this overall range instead of back higher. So more of a risk-off look in healthcare. Industrials, what do we see? Sort of hanging out at the bottom end of the range. Again, we don't want to see this breaking down to new lows here. Ideally, this bounces, plays kind of nicely down here. Not a heavily weighted sector, so I'm not overly concerned with it. But, this hammer would lend itself to the fact that maybe there's a little bit of upward pressure here. Again, the big thing we want to avoid is just, nasty follow through to the downside underneath roughly the 94 area. So see if we can hold up here inside of industrials, but not the biggest concern of mine. Inside of financials, again, this strikes me as just being more concerning, falls more into the concern camp of risk off. Obviously, our lower high phenomenon continues here with another lower high from the FOMC sort of turnaround and retracement. We are getting some significant lower wicks here, but really until we can come back up and get a strong close above and then make an equal high to this general area, I'm not convinced that financials are in a decent spot here. The risk is really for continuation lower instead of neutralizing and finding potentially a sideways trend here. Remember that we have made from here to here a significant new lower low. It's really going to take a lot before this falls back into the more acceptable sort of risk on, so to speak, category. It's just not exhibiting that type of behavior as of right now. XLK, perhaps the most important sector for the S&P 500 itself. Notice that we just have this choppy section on the Wednesday video. We were talking about the close above our sort of neckline of this prior double bottom. Yeah, all of that's been retraced. Obviously, we're getting a bearish acceptance day on Friday underneath sort of the lows of this balance. It doesn't look promising. We do have the lower high phenomenon. We have all of these equal lows, this sort of balance area in here. If we do start to see a significant breakdown, obviously that does not bode well for your S&P 500 itself. For this to flip back to bullish, it's got to produce a higher low above this sort of top end of balance in here, around 147. Currently, doesn't look like a strong outcome into the earlier part of this upcoming week. Real estate, what do we see here? Again, just more weakness. This is fine. This is actually a decent look for the S&P 500, remembering that this is more of a defensive sector, right? As long as it plays nicely in this overall range, fine. Again, the look we want to avoid is just an all-out breakdown underneath 44 inside of real estate. What do we see in XLY for consumer discretionary? Obviously, with Amazon being a massive drag to the downside, this has ultimately given up the bottom end of its range. It did give us a little bit of a dead cat bounce. Basically, nothing bullish to see here inside of the XLY. Even if this bounces, again, I'm not overly confident in any of these providing a more bullish look until they can put in that higher low above the FOMC sort of spike. And based on Friday's action, again, doesn't strike me as a likely possibility into the upcoming week, or early part at least. What do we see in materials? 3 equal lows. These are dead on the money. I mean, it doesn't get any better than that. Nonetheless, it's a hammer candle. It did not make a new lower low. So for that reason, maybe there's a little bit of follow through here. But remember, what is the XLB, right? Materials. It's a tiny percentage point of the S&P 500 makeup. So even if this does bounce up towards this 88 sort of highs, top end of balance, it's not going to be a huge positive force for the S&P 500. So as long as this just remains nicely above sort of 80, 50, 80 as a whole number, fine. Just more neutral for the marketplace. This is what we want to see here. We don't want to see it leading the charge, and we also don't want to see it breaking down. So I would say that this chart right here is perfectly fine and acceptable, kind of healthy for the S&P 500. And then the last one here, communications, XLC, not a good look. Remember that we discussed in last week's video, even if we got some sort of bounce, it strikes me that this would offer significant resistance. Yeah, we didn't even get to 64, and we've already rolled back over towards the bottom end. This is certainly starting to look more like a bear flag, looking for breakdowns here. This obviously is not a risk-on look for our S&P 500. Let's quickly wrap it up in terms of sector department, at least with our S&P ratios. Then we'll flip back over to this internal screen. So the big four at the top are, of course, our risk-on sectors. Notice that the XLK is pulling back off of the 50 SMA. That's the gold line there for a clear set of lower highs, more of a risk-off indication. Healthcare, kind of just more muted in this upper range, bouncing off of the gold line, 50 SMA. It's decent, but 1 of 4 is not enough to sort of change the trend in the SPY itself. XLY falling off of a cliff, as we discussed with Amazon, looking pretty horrific. And the XLF, again, some concerns here. It is holding on to the double bottom, but notice how also we're just getting lower highs. It would be more ideal if this could really perk up and potentially spend some time above the gold line, but it currently does not look like that's in play, at least into the early part of the week. Again, more of a descending triangle type look with clear lower highs and flat lows. The bottom four, again, are just going to reinforce the idea that it's a risk-off market here with consumer staples, even though they were down, perking up, right? On a relative basis, they were stronger than the S&P 500, so they ticked up on Friday. It's a risk-off indication. Energy continues to scream to the upside obviously risk off indication as well. Real estate hovering around that upward sloping 50 SMA. It's not the worst sign here as we discussed on the chart itself, but it still is above an upward sloping 50 SMA, which would strike me as still being in a bullish trend. And of course, utilities perking up as well, well above their 50 SMA gold line here, making an attempt to get out of this prior range that it was stuck in for quite some time. So overall, sectors are confirming a risk-off type of look. Let's go back on over to our charts, take a quick peek, at the VIX here. What do we see in volatility? What I think has been interesting about this whole thing, and we've discussed this on the Wednesday video as well, is the fact that volatility didn't really perk up and make a new significant higher high here, which to me is kind of, I don't want to say concerning, but it's divergent from what we've essentially seen in the SPY itself. What I think would be a little bit more healthy in terms of trying to put in a significant bottom in the S&P is, let's say the SPY really breaks down, it gets into that 395-ish area early on in the week. If the VIX can spike and get into that 40 handle and then start to taper back off, that to me would be a much more healthy look in terms of what volatility should do if we're going to find more of a local bottom. Notice that every time we've really spiked up towards those extreme levels, much closer to the 40 handle, not so much this 33, that's where, again, we've gotten more of a rally type look in the S&P 500. So watch for that. If this VIX can repair itself with a spike to 40 and then retrace back down, obviously that would be a better look for the S&P 500. And on its way back down, another thing I just want to point out here before we move along is if we draw in a trend line like this, you can clearly see that the VIX has been respecting this quite nicely. So if for some reason this scenario that we've outlined pans out, let's see if we can break that trend line and actually get back down underneath 2050. Again, it doesn't strike me that that wants to be something that does happen early on, just because I do think that there's a lot of risk in the marketplace to the downside. It looks risk off right now in terms of outlying capital. I don't really think that it wants to get down underneath that 2050 anytime soon, but if that were to happen, again, now you know what you're looking for, at least if the market's going to make a significant turn here early on this week. So that's the VIX. Let's get on over to the internals now. We'll flip this screen back on over to what we had originally. Sorry for any confusion. And by the way, if you're not familiar with this screen right here, I've got a whole video on how to set this up and what it all means. You can watch that in the top right-hand corner here as I just quickly adjust these so we can see what's kind of going on here. My main concerns with the market overall is just the fact that on Friday we did get a digestion day, and we've been discussing this on the Wednesday videos. We even discussed it on last Sunday's video. Notice here we have extremely high degrees of correlation to the upside. Generally speaking, that's not sustainable. We look for the opposite to happen, more of a balance and digestion at the midpoint. Unfortunately, on Thursday, we've gotten just the same thing, if not even worse correlation to the downside. Notice how all of these advanced decline reads are underneath negative 2,000. That is not sustainable. So again, we look for more of the next neutral read, and from there, we would sort of expect, if we get balance, we look for lower. If we get more of a trending day back to the upside, but within the healthy bounds, maybe this was a little bit of a bottom. Yeah, notice what happened on Friday. We get digestion in terms of fixing this oversold read here, but it is still certainly within the camp of the bears there. So because we see the advanced decliner in bear territory, because we got consolidation in bear territory, we are looking for continued downside. And ironically enough, the futures market did just open about 5 minutes ago, and you can see the first move as of right now is actually to the downside. It doesn't mean that Monday has to open on a complete bloodbath, but for now, again, things are pointing in the downward direction. That's kind of all I would say about our internal screen. And then the last thing we'll talk about for the SPY itself, we don't often look at this chart, but I do think it's at least worth pointing out on today's session as we're trying to quote unquote hunt for bottoms. If I just zoom in on the same section of chart here, this is the percentage of stocks that are trading above their 200 SMA on the daily time frame, and this of course is the SPY itself. You'll notice that every time we come into a significant bottom in the SPY, we at least dip a toe into this yellow box down here. Notice there, here, obviously here, here, and you can see all of these instances, but we're not quite at that extreme level where we've broken down to the point where ultimately so many things are trading underneath the 200 SMA that we would generally look for a little bit of reprieve. We haven't quite made it there, which also fares into the bear camp, meaning that there could be some more downside to go before there's a more meaningful reversal in the SPY itself. So I did want to mention that on today's video. Let's get back on over to our other setup here, and we'll just expand this one on the left. So we've got our daily, fantastic. Let's go on over to the Qs and round out our broad market section here. This is going to be very, very similar to the SPY itself. Notice your expected move is right here. It's at the secondary resistance trend line. It is at our intermediate resistance as well. If I quickly flip this to a 30-minute, you'll be able to see that. So here we go. Support, then flips to resistance, resistance, resistance. Cannot hold it here. Break back down happens. And then on the FOMC, again, it's also the base of the spike of the single prints on the way up and on the way back down. So that's 322.50. Remember, ironically, that the SPY is 422.50. That's an easy way to remember the importance of those two numbers right there. So that's why it's on our chart. We will continue to carry that forward as significant resistance, just like we talked about on the SPY, carry forward this level as weak because we now have 3 exact touches to it at 329.50. Again, it's not my primary thinking early on in the week, but if for some reason over the course of the week, and again, we'll keep you updated on Wednesday, we get into this, I would look for that to break on any subsequent tests, noting that it is a weak level. To the downside, again, bearish acceptance on the Friday session, making a new significant lower low here as well on the Friday session, whereas in the SPY, we also had that Monday lower wick, right, where they were more equal. Yeah, notice that we've essentially closed underneath all of that support here in the QQQ. So as long as we remain, I would say, to be quite honest, underneath 318, bear camp here, looking for breakdown underneath Friday's low for continuation, and our next support underneath is coming from 297.50. If I scrunch up the chart here, we've got to grab another year. So let's do that now together so I can show you where that support's coming from. 297.50. Look how we have right here. Big resistance. We get a break, retest, and then go. We've already tested it once for support. On the first touch, there might be a little bit of support, but ultimately speaking, I wouldn't treat that as strong as the level we saw in the SPY, which has been untested since it was broken in the first place. And then underneath that in the QQQ, we do have 287.50 coming from intermediate support in here. If I just zoom in on that section of the chart, you can see prior support flip to resistance, resistance, and then support in here as well. That's where those numbers are coming from, and those would be my downside targets early on in the week. Again, this strikes me as a bear flag like this. If we just take out the Fibonacci's to be congruent here in our QQQ, coming in from top to bottom, if we go to the low of Friday, notice that your 38.2 is aligned just like in the SPY with that 322.50. So for now, again, I think more things fall into the bearish territory, and we are looking for one more leg down to sort of give us that big capitulation bottom maybe. That's maybe when our 200 SMA sort of chart there gets closer to that yellow box, and from there, we would potentially look for reversals. Who knows? For now, the short-term outlook is certainly in bear territory. Let's round out the broad market with IWM, Russell 2000, and our small caps. You can clearly see, again, a new lower low on the Friday session, bouncing right off of that 180.75 level. If that gives out, the bottom end of our expected move is roughly aligned with a support zone underneath us from 175.65 down to 173.50. If I scrunch up the chart, hopefully I've got enough time here. Yes, I do. We can see that. Apologies, this is going to be quite nasty to look at as I first zoom in, but if I just do something like this, there we go. You can see how there's basically very thin structure in this overall area. It's not quite a gap. Technically, it did fill based on those two wicks being overlapping there, but overall, not a lot of structure in here. So if the IWM does continue lower, I would treat this zone as quite important here. Again, just to reiterate those numbers, 175.65 down to 173.50. Let's pop this back on auto and go on over to the recent price action. In terms of upside, just like we've been discussing, the upper end of the expected move on the week is coinciding with that area here, 189.50s on the intraday chart. You can see that as support, resistance, opening range, and then breakdown fails as resistance here. No love on the spike from FOMC, so carry that forward as significant resistance as well. Again, that's 189.50 here in IWM. If you just want to use this like I do as a risk on, risk off gauge, it's been in risk off territory for quite some time now, noting, again, our first real breakdown here of the overall range should have had you being a little bit more skeptical of strength in equities overall. So that's an in-depth look at our broad market. It appeared that in last week's video, all of the votes were in favor of in-depth looks, so we'll continue to do that as long as the charts sort of permit. Let's get into these companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, let's jump right into Apple. We are still clearly in the box of chop. In here, I would say, don't be married to a directional bias. Be fluid. Probably focus on day trades only here. It's very, very difficult for Apple, or at least it seems this way, to get any sort of traction and follow through one direction or another. At this point in time, I would say longs are only favorable if we can crack up and over the resistance trend line to do something like this. Don't get me wrong, for day trades and scalps, you can long off the bottom end of this range. That's fine. But for the easier long to identify on a larger time frame, again, just watch for your resistance trend line to break. That'll be a much cleaner signal for upside. And to the downside, I would even say I would be skeptical even in this area here until 152.20 breaks from this prior double bottom right here. If that goes, then yes, it does open up the door for more downside. Our next significant target is 147, and that's coming from, if I scrunch up the chart, prior support in here, really where this initial rally was staged from. We have yet to test some of those levels, so that would be my first downside target, at least early on in the week. I would say that Apple would fall into the bear camp just because we are consolidating underneath on Friday a 200 SMA, as well as this pivot that you can really see only on a smaller time frame chart. So notice we have support, resistance, support, a little bit of congestion before this breakdown happens here, congestion on the way back higher, and then again resistance on the Friday session. So this is also just a great illustration of the volatility. Down, up, down, up, down, up. The moves are absolutely wild here. Again, as long as you remain underneath that, I would sort of be in the camp that this is bearish acceptance at the lower prices. I would favor downside. And again, the easier to identify long is up and over the resistance trend line, but it doesn't mean that there can't be day trades back and forth in here. So Apple, take it one step at a time, really for more of a clean direction to be established, wait for a move outside of this box. Let's continue along and get into Netflix, clearly in the bear territory as well. If I just get this all the way off to the left so the chart adjusts, you can see that we're breaking down from this bear flag. Friday was day one of breakdown, essentially, so we are looking for some more downside. The only sort of concern is the lower wick that we've seen here. We know our next major support is around 165. I would look for the chart to eventually get there. If we do see some bullish activity early on in the week, I would just look for this to do a break and retest, something that does this, right? Here's your break, there's your retest, looking for shorts against the bottom end of this prior balance around let's call that 190 just for round numbers sake. And then again, your target is down here around 165. If it does something like this, that's fine. I wouldn't necessarily look for the long on the higher low here. Instead, I would wait for a break up and over the top of this balance for a little bit of a squeeze into the bottom end of this breakdown point here around 210.75. We've been talking about that level for quite some time. It does strike me as a really significant resistance if there's any sort of upside here. And again, it would probably only happen if we see a scenario that looks like this. So that's Netflix in a nutshell. Let's continue along and talk about Tesla. What's going on in Tesla? Just like in Apple, this is kind of in a nasty box right here. Very, very difficult to get any sort of follow through on anything longer than a day time frame trade. I would point out that we are supporting at a support trend line. There's your touch one. Here is touch two on the Friday session. A little bit of a lower wick. Notice we've also closed above that 861 pivot. I'll show you that on the smaller time frame. So you get support, support, support on the open there as well, right? And we did close above that on the Friday session. It's not the strongest level out there, but I did think it was noteworthy and at least worth including in today's presentation. As long as we're above that and we're supporting for higher lows on that daily support trend line, maybe it's just a rotation to the top end of the range here with a stop just below, right? The risk reward here might make sense if something like that does end up setting up. But just like in Apple, for the easier to identify longs, it's either longs up and over 945 or shorts down and out underneath the bottom end of this overall range. I would say a break of Friday's low, I take it back, even just a breakdown of that level we've seen here at 861. If that starts to go, I would just look to fill up this triangle right here and get into that 800 mark coming from significant support, 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 and support in here as well. So that's what we've got to the downside. Anything underneath that, 755 could be a likely target for Tesla. After that, it would really require reevaluating the chart, right? As we break out of these areas, and the same will hold true with Apple, how we break out of them does matter here. So we'll give you an update if that were to happen on the Wednesday video. Let's continue along and get into AMD. This is the only thing that strikes me as having some relative strength, big sum there, just because obviously we have multiple inside bars stacking after the FOMC and earnings sort of announcement all from the Wednesday session. But notice here how there's at least the possibility that this builds out as an inverted head and shoulders. There's still no actionable long until we get a clean break up and over 100 with confirmation. So what that might look like would be a strong candle close above. It might look like a break and retest for you to get interested. Could look like a number of things for confirmation, but nonetheless carry forward 100 as your critical long side pivot here inside of AMD. For you short-term scalpers, again, breaking out of this multiple inside bar setup, you're probably looking for a target here on, it could be a day trade depending on how big momentum is, but depending on how big volatility is in the broad market. Basically 106 could be an upside target. Do be mindful though of a declining 50 SMA here in blue as well. That's the upside look. Anything after that, really significant resistance trend line coming from the all-time highs here inside of AMD. You can see that look there. Breaking down out of this 3-day balance obviously invalidates the head and or inverted head and shoulders pattern, and we would look for the bottom end here equal low around 84.60. That would clearly provide a lower high from this perspective, and then breakdowns here get much more attractive for some significant follow through to the downside. Let's continue along and get into Facebook. What do we see in FB? Breaking down, unfortunately, underneath that 210. I do still have a long position in Facebook, a very long-term long position. Anywhere from 3 to 5 years was the time horizon I was willing to give it. Obviously, I'll consider stopping out if things deteriorate in a significant manner. As of right now, it's fine. But nonetheless, this giving up of 210 strikes me as a little bit concerning. Notice that if this next level goes around 202.15, yeah, earnings gap is certainly in the sights here inside of Facebook. That gap is going to fill from 193 down to roughly 181. That's probably the best short trade to be looking for. It could come early underneath that 202.15. So anything that does this and then another lower high, yeah, you're probably going to want to be looking for short positions on that lower high. If you're a little bit more conservative, fine, just look for the gap and enter potentially here as we start moving into it. So that would be the favored look here if we give up this 202.15. If we get any sort of early weak bounces and do something like this, that's fine, but I'm not, again, with the whole failure here on the FOMC sort of spike, I really wouldn't be, overly confident in longs until we can take out that sort of euphoric high there around 225. And from that, maybe there's a possibility we come up and scratch at the bottom end of this overall earnings gap from in here. Wouldn't be my first thought into the earlier part of the week. Instead, I would really just want to see how this 202.15 resolves. If we remain above, again, probably more cautious on the week. And if we start breaking down underneath, probably looking for this gap fill scenario to unfold. Next up, we've got NVIDIA. What's going on here? Clear weakness in relationship to AMD, both kind of being in that chip space. Notice how this is clearly inside of its bear flag, inside of its area here. Notice on Wednesday from the FOMC, look above and fail. That trade has been fulfilled. We came down to the bottom end of the range. We tagged it. A little bit of a look below and fail on the Friday session. Nonetheless, we've still closed in the range. Any daily bars that close underneath 185 quarters start to get interesting for more follow through into 170, 175. To the upside, again, not really looking for anything significant at this point until we can crack out of this range. Really, you might get a heads up at 199, but I would personally want to see it above that fake break high here. And potentially at that point, it's probably worth it to watch for a daily resistance trendline break as well to start to do something like this. There's a lot of overhead resistance in this general area, roughly between, let's just go ahead and hover the cursor there. Let's throw a level on there. 204 roughly it was, I believe. Let's do something like this. Yeah, let's call that 204 up to 209. A lot of overhead resistance in here. If it can break, fine. But again, there's a lot of work to be done before that's even remotely in play early on in the week. Notice again, all of the consolidation is favoring sort of a big bear flag look like this, and downside should probably be favored in this particular scenario. Underneath 170, 175, as we've discussed in prior videos, 155.50 is your next target. Microsoft is up next in a box of chop, just like Apple and Tesla. If I do something like this, and there you go, nasty moves down, up, down, so on and so forth. Crazy look here. What we are starting to build out, though, is a big flush point around 271. If this level breaks, and again, we do have more of a bearish look and bearish consolidation and acceptance on the Friday session. If that breaks at 271, look for some follow through, and your downside level up next is going to be 261. Can we see that on a year chart? Not quite. Let's grab another year so I can show you where this structure is coming from. Big prior breakout level at the 261 that has not been tested yet, and then anything underneath that gets us into 250, 250, coming from the neckline of sort of this double bottom right here, which led to higher as well. So first up, 261, that would probably be the level I carry forward as very significant, about $10 lower if this overall low end of range right here breaks down. To the upside for your more easy to spot longs, again, it's up and over the top end of the balance. Does that strike me as a likely possibility into the earlier part of this upcoming week? Not necessarily. necessarily. Again, we are getting price acceptance lower instead of up here closer to the top end of the range, which could lead to breakouts. Wouldn't be my favorite line of thinking early on in the week. Last but not least, the beast here, we've got Amazon. What's going on in Amazon? Let's zoom in here. As we know, a bit of a drag on the marketplace. We saw that in the XLY. It did not take out the 2-day highs here that we were discussing in the Wednesday video. Unfortunately, this gap is obviously not in play anymore, and we are getting acceptance underneath the lows from the earnings sort of gap down and the subsequent lows that sort of formed around that. So to me, it definitely falls into the territory of bears, and you can see it's more of an inverted hammer look. So if we get breakdown of the Friday low, which ironically enough, 2250 is a significant daily and weekly level. I can't quite see it here on this time frame. Let's go ahead and just flip this to a weekly. Here we go. This should be a little bit easier to spot here without so many candles to look at. Apologies for fumbling through the platform here, but nonetheless, there we go, right? So big bull flag, formed in the past. That's exactly where we bottomed out on the Friday session. If that breaks, notice that we have very, very thin structure that happened on this breakout here. The next major level we're looking for is 2030, quite a ways to fall here inside of Amazon. Now, the weekly look is starting to get a bit overextended to the downside, so I'm not sure I would chase it on short entries here, but overall, I certainly would not be feeling warm and fuzzy on long entries either. So overall, the entire marketplace is sort of poised in a bearish spot. Hopefully these big boy companies sort of aligned with the outlook for the broad market. Let's get into these individual trade ideas. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that being said, we will jump right into Walmart here as our first trade idea. Now, this idea does require a little bit more pain into the earlier parts of the week. Basically, what we want to see is continued breakdown into this 146 level, which we can see as prior resistance right around in here. And if we get there, my expectation is that we see a little bit of a dead cat bounce off of that level. We're not going to overstay our welcome on the long side, but it does strike me as a reasonable place to start bottom fishing for long opportunities, even if they are just a bit of a dead cat bounce. We are bouncing a little bit on the Friday session at that 50 SMA, so if it doesn't break down further, then I'm not sure I would chase it, kind of for something that does this, noting that it might get choppy back in this overall section of the chart. The reason I do think we can see more downside early on in the week is because Friday is just day one of a potential breakdown. Notice that before that, we had all of these equal lows, lower highs coming into it. When it breaks, we get day one. Maybe there's going to be day two of follow through, and it gets us closer to that risk reward entry point around 146. So Walmart, looking for longs, looking for some bottom fishing, 146 is your number. Next up, we see NRG for Energy Inc., right? NRG, Energy. Nonetheless, enough with the wordplay. You can clearly see we're coming in for an equal high right around these areas. Earnings were a big factor on the Friday session, but it did lead itself to having an increase in volume here. So two ways to play this to the long side. We are looking for first a higher low pullback and then a reattempt here in short proximity of time for a break of 41.33 to get into 43.33. So roughly a $2 move available to the upside from this perspective. Or if you're a little bit skeptical of taking the breakout, you could watch for something that does this. Higher low pullback that holds this breakout point could also be your entry point with a little bit more confirmation now that the level has broken. The reason we're fishing for long, or not really fishing, but looking at longs inside of energy is because obviously the energy sector itself, as we saw, is continuing to break out to the upside. So it wouldn't be my first idea to go short here, but I also wouldn't call you crazy if you think that the entire market needs to pull back and sort of fall apart a little bit. You could also build the case for a tight risk long here, noting that you have a stop here, sort of short entry here, looking for a retracement through this thin structure. Again, you might find a little bit of support around this 39.50 coming from the prior highs here and here. But again, I wouldn't call you crazy for looking at that this chart here either in that light. Nonetheless, an inflection point here inside of NRG around 41.36. However you want to decide to trade it, that is going to be up to you. But for me, I'm looking to go in the direction of the energy sector as a whole, which currently is up. Last but not least, we have UPS, the shipping company, of course. And what I would point out here is a long-term support potentially coming into play. We have this 178-ish level. We have multiple hammer candles and longer lower wicks that have been forming around this area. In the shorter time frame, you could certainly build the argument that this is a bit of a double bottom. If we get a bounce up and over the neckline around 183.50s roughly, you'll notice that there's some room to run back to the top of this overall range around 190.150. From there, you can choose to monitor for continuation, noting that we have thin structure on the breakdown here. You could target the moving averages. There's a number of things that you can do, but basically what I wanted to point out in this setup is the potential for a bounce off of this strong support coming from our first sort of interaction back around in here. Again, your entry point is over the short-term double bottom neckline at 183.44. 183.50, however you want to decide to use that, nice round number there. If we just get consolidation here, obviously, if there's no sort of break of this neckline, there's no long trade to be had, noting that we're getting bearish acceptance underneath this prior area of balance right here. And again, the longer we go sideways without forming a new higher high above that neckline, the better it looks for a breakdown. But at least in the short term, I would look at this hammer candle and say, okay, if we can take out the neckline, I am looking for longs for that trade that we've just outlined. So that's going to wrap up our trade ideas. That's going to wrap up the video. If you enjoyed it this week, let me know down below in the comments section or by giving the video a thumbs up. Don't forget that our midweek market update will come out on Wednesday as scheduled. And with all of that being said, I wish you a green trading week.